So question number 12 is going to be the next question where we are going to learn one new concept. Till now we have solved questions where we have calculated net present value. But what about adjusted net present value? If you look at this, this is where we are going to calculate adjusted net present value. Have a look on this question. See. The management of multinational company TL Limited is engaged in a construction of infrastructure project. A proposal to construct a toll road in Nepal is under consideration by the management. So we are about to construct a road in Nepal. Okay, toll road. The following information is available. Now, what do you mean by toll road? It means that you can construct that road and then you can start taking toll tax. Then you can start taking the toll tax. Okay. The initial investment will be in the purchase of equipment which will cost around 250 lakhs. The economic life of the equipment is 10 years. That's why 10 years will only be available for depreciation. The depreciation on the equipment will be charged on the straight line method. So I think 250 divided by 10 if there is no salvage value. So 25 lakhs per annum will be the depreciation cost. And on this we are going to save some taxes. EBITDA to be collected from the toll road is projected to be EBITDA, earning before interest, depreciation, tax and amortization. So these are the operational earnings in cash flow, like in cash terms, because we have not deducted the interest yet, nor the depreciation, taxes and amortization. Nothing has been deducted from this value. So this is a pure cash flow, operational cash flows. So 33 lakhs per annum will be the toll tax collected, and that too for 20 years. See, you can see the investment is for 20 years, but the life of the equipment, economic life is 10 years only. Obviously, we are going to use it till 20 years, but we can depreciate entirely in 10 years. To encourage investment, Nepalese government is offering a 15-year term loan of USD 150 lakhs at an interest rate of 6% per annum. So, there is one thing that you need to understand because of multiple duration in the question. See, 5, 10, 15, 20. 5 years, 10 years, 15 years and 20 years. So the very first thing which is given was the depreciation. That you are going to utilize for 10 years. Then toll revenue you are going to collect for the entire 20 years. Then loan amount that you are going to make a repayment in 15 years. So you need to understand the timeline and restrict your cash flows related to these parts for that timeline itself. Okay. So 10 years, 15 years, 20 years. Now, to encourage the investment, Nepalese government is offering 15-year term loan of 150 lakhs at an interest rate of 6%. So interest will be 150 into 6, that's around 9 lakhs. Yes, 9 lakh US dollar will be annual interest, and that too for 15 years. The loan will be repaid at the end of 15 year in one tranche. That means there is this loan repayment is not on a reducing balance method. There are no EMIs. Every year you are going to pay 9 lakh as an interest. 9 lakh dollars, US dollars. So interest will be 9 lakhs every year. Revenue will be 33 lakhs every year, and depreciation will be 25 million or lakhs every year. Am I right? But 25 lakhs for 10 years, toll revenue for 20 years and 9 lakhs for 15 years. Okay. The interest is to be paid annually. Okay. The required rate of return for the project under all equity financing. That means if we do not take the loan, and then do the entire financing, the required rate of return will be 12%. Post-tax cost of debt is 5.6%, in case you want to calculate the present value of interest separately. KD1 minus T. This is KD1 minus T. Corporate tax rate is 30%, all cash flows in dollars, ignore inflation. You are required to advise the management on the viability of the proposal by using adjusted net present value method. Now understand what do you mean by adjusted net present value. It is very simple, sir. You have to first calculate the base case NPV. What does that mean? First of all, assume that you are going to entirely finance this project through equity and discount all the cash flows, calculate the basic NPV at 12%, assuming there is no loan. Okay, you can calculate that easily. And then in order to find out that what will be the benefit of taking the loan, you are going to add the tax shield on interest, because that is where you are going to save some taxes. So now, after calculating once the NPV based on all equity financing, the entire 250 lakhs you are going to use for use with base case, use with equity. Then you are going to assume that what if I add 150 lakhs as a loan and pay interest and save some tax on that. In that case, the benefit of the taxes will be added to the base case NPV, and then that will become adjusted NPV. So it's very simple. All equity finance NPV plus the benefit of what if you will take the loan, benefit of tax shield on interest. That's it. Very simple. So let me first focus on base case NPV. Now this base case NPV will be discounted at 12% because it is all equity financed, and this will be discounted somewhere I think at 5.6% or 8%. Yeah. Post-tax cost of debt is 5.6%. Now after tax it is. Okay. Let's first find out the base case NPV. What are the cash flows that we are going to take in the base case NPV? In the very beginning, there will be an outflow of 250 lakhs. Okay. Second thing, you have to show the inflow of 33 lakhs every year. Out of that, you are going to pay some taxes for 20 years. Then you are going to show some tax saving on the depreciation for 10 years. Or it's better to show the tax saving on the depreciation separately because it is only for 10 years. Show after tax revenue of the toll revenue after tax for 20 years. That's it. This is the only thing in this all equity financing. So have a look on the answer. It's very simple, sir. First of all, this is initial investment at 0 time. Therefore, the factor is 1 and the outflow is 250 lakhs. And then you are going to earn some EBITDA. You can clearly see there is an EBITDA. Okay. This EBITDA will be for 20 years at 33 lakhs. What I want to say is, instead of writing tax in a separate row, you can just write down 1 minus tax here and take the net figure 33 minus 9.9 on a single row itself. You can save your time in that case because otherwise everything is same 1 to 20 years. So the net of 2 should be taken, and at 12% you can see at the end of the question present value factors are given. 12% for 20 years, 7.469, you can get the present value here. So one item is this, after tax revenue is this, and tax saving on depreciation. See, this depreciation is not considered here. Depreciation is not a cash flow, sir, but tax saving on depreciation is a cash flow. So for 10 years, we are going to save some taxes because of the depreciation, which is 30% of 25. And for 10 years only, you are going to take the present value factor, and that's the present value. This is the NPV which comes to negative if you do not take the loan. This is the base case NPV. On that basis, what will you decide? Do not accept this project. But if you take the loan of 150 lakhs, what will happen? If you take the loan of 150 lakhs, you will pay 9 lakh as an interest every year, and you will save some taxes on that. Now, If you come to this point, they have given alternative answer. I will just show you what exactly is used everywhere. This is the only factor which is required to you. Tax saving on interest. Loan is not required, interest is not required, repayment of principal is also not required. All of them gets cancelled with each other itself. Tax saving on interest. So tax saving on interest is 9 multiplied by 30%, and at discounted at 8%, that's 8.559. So the tax saving on interest for the 15 years, you remember 15 years, comes to 23.109. So if you follow this one, this is the base case NPV, this is the base case NPV plus present value of tax shield on interest. So this is the outflow. Yeah, see, there is a negative sign here. So this is negative NPV plus positive savings on interest, and still there is a negative NPV at the end. And that's why what we are going to say, adjusted NPV is negative, hence we should not accept the project. So adjusted NPV is nothing but the new NPV arrived after considering the tax saving on interest. Okay, so this is what you will find everywhere. If you search on the formula for adjusted present value on the internet, this is what you are going to find out. But institute has taken some other factor also. Base case NPV plus present value of the impact of financing. Logically, this is right. Now, what is the impact of financing? That means if we take the loan today, okay, this will be our inflow. So we considered this, multiplied it by 1 because today's factor is 1. And after that, for the next 15 years, we are going to pay interest. That's why outflow. So we discounted it at this 15-year factor, 8.559. Okay, interest. And the tax saving on interest, obviously, if this is an outflow, this will be an inflow. We are going to put this interest as an expense in the profit and loss account, and we are going to save some tax on that. And at the end of year 15, we are going to repay 150 lakh as a principal repayment, and that will be this amount. So the total impact of debt is positive 48.828, and it's very apparent from the point that you are getting to use, like you are using 150 lakhs, you are taking 150 lakhs today and paying back the same amount after 15 years. See, this 150 has reduced to 47.25 over a period of 15 years because you are repaying the same amount. And it's ultimately costing you, like it's ultimately a benefit to you, 48.828 positive value. Getting it? So if you adjust that benefit of taking the loan, not just the tax saving on interest, but if you consider the outflow of interest, inflow of the loan in the beginning, and outflow of the repayment of principal. This is inflow in the beginning when you receive the loan. When you pay the interest, this is an outflow. This is inflow, which is a tax saving, and this is outflow, which is a repayment. So if you take the present value of all of them, then there is a benefit of 48.828 lakhs, and then you can see that you have a positive NPV. So if you go ahead with by taking a loan, you can see the same project becomes profitable if you use the debt in the market. So always, the debt is not always wrong. It's not bad. There are good debt and there are bad debts as well. This is a good debt because you are using it to earn. So 13.737 will be your new adjusted present value, and this is positive, so you can accept the project. Now what should be done in the exam? In exam, I will suggest you to go with both the option and exactly show the answers like this. Once by considering all the benefits of debt, loan received today, interest paid for 15 years, tax saved for 15 years, and loan repaid. What else is there in the loan? When you take the loan, you start paying interest. So consider that. You start saving taxes, consider that, and make a repayment and close the matter. So by taking the entire impact and just by taking the interest, tax saving on interest, you show the answer just like the institute has done, and you will get the full marks. Don't take chances. So have you understood this? Base NPV is the net present value arrived after using all the investments from your own pocket. Not even a single rupee was debt in this. And that's why you ended up having negative NPV. I will tell you why. Because when you use your own money now, the cost of capital is high in that case. You expect more return on that. But in case of debt, you do not expect that much of the return. So that's why 8% was used there. 8%. How did you calculate 8%? It's 5.6% divided by 70% before tax. That's 8%. And the factors are given to you in the question. I hope this question was pretty easy for you. Okay, sir, let's move on to the next question. This is going to be another interesting question for us. See, question number 13. Opus Technologies Limited, an Indian IT company, it's an Indian company, is planning to make an investment through a wholly owned subsidiary in a software project in China with a shelf life of 2 years. So have that visual in your mind, that to have that visual memory of 2 years. The inflation in China is estimated at 8%. So this is the first thing, inflation 8%. Since this question is so big now, it's very important in such type of question to mark the important words only, so that whenever we want to pick any particular figure, we can easily catch that. Operating cash flows are received at the year end. For the project, an initial investment of Chinese yuan 30 lakhs will be in a piece of a land. So 30 lakhs in land we are going to invest. The land will be sold after the completion of project at estimated value of 35 lakhs. It will be sold at 35 lakh. See, there is no depreciation in case of land. So the gap of 5 lakhs, you can see it will be purely capital gain on which you will have to pay capital gain tax. So you can prepare a working for this. Sold at 35, less purchased at 30, capital gain 5 lakh, less tax paid on the capital gain, and balance amount received at the end of 2 years. How much is the tax rate? Let me just check once. Somewhere here, I see. The capital gain tax rate on business income and capital gain is 25%. Okay. So can I write it like this? See, 35 sales minus 30, so 5 capital gain, and on that 1.25 will be tax, and the balance will be received by you, 3.75. See, you will receive 5 lakhs. However, you are going to receive more than So how much you are going to receive at the end when you will sell the land? The amount that you will receive is 35 lakhs. So the cash flow is this, 35, and outflow is this. So 35 minus 1.25, this is the amount that you are going to receive at the end, 33.75 lakhs after paying taxes. Cool. Now let's go ahead with the other part. The project also requires an office complex which will cost 15 lakhs payable at the beginning of the project. The complex will be depreciated on straight line basis over 2 years, and the complex will be depreciated on straight line basis over 2 years with a zero salvage value. So what will be the depreciation? 7,50,000 will be the depreciation. Okay, because they are going to depreciate it to the zero value. Cool. Now, the complex is expected to fetch 5 lakh at the end of the project. This complex will be sold at the end of the project at 5 lakh when the written down value will be 0, because you have depreciated everything. So, practically speaking, you will be selling the complex at 5, the value of which is 0 at the end. The entire 5 will be capital gain, and you will again pay tax of 1.25 on that, and the balance amount will be received by you. That's 3.75 lakhs. Okay, sir. So 3.75 will be received at the end by us. The company is planning to raise the required fund through GDR issue in Mauritius. So we are from India, we are investing in China, but raising the funds through Mauritius. Okay, so the discounting rate on which we are going to discount all these cash flows will be the issue cost, that is the cost of capital that we are raising the funds from. So whatever is the cost of GDR will become the discounting rate for these cash flows. Each GDR will have 5 common equity shares of the company as underlying security, which are currently trading at 200 rupees per share. So 200 into 5,000 rupees. Okay. In the domestic market, the company has currently paid a dividend of 25%. When nothing is given, it is assumed that the dividend is in the form of rate. Rate is applied on face value, yield is applied on market price, payout ratio is applied on earnings. So this is a rate. 25% on 10 becomes 2.5 rupees of the dividend that is currently paid. This is D0. And which is expected to grow at 10% per annum. The total issue cost is estimated to be 1% of the issue size. Now understand, 5 into 200 is the total price, less 1% will be received by you as the net proceeds. So that is around 1000 minus 1%, 990 rupees something, right? 1000 less 1%, 990 rupees you are going to receive. So ultimately you are going to calculate the cost on the amount you are using, which is 990. How to calculate the cost of capital? Through the Gordon's growth model. See, it's like market price is equal to D0 into 1 plus growth divided by cost of equity minus growth, right? So let me first shuffle this formula in order to make it a formula for cost of equity. So cost of equity minus growth is equal to D0 in bracket 1 plus growth divided by market price. And when we transfer the growth on that side, it will be D0 in bracket 1 plus growth divided by market price plus growth, right? Now dividend is 2.5. It will grow by 10% every year, and the market price will be like this, 990. Net proceeds has to be taken, 1% less issue cost, right? Plus growth of 10. Now 2.5 into 1.1 divided by 990 plus 0.10, that's somewhere around 10.28%. Let's see what is the actual cost of equity, or the cost. We'll look after it. Now the annual sales are expected to be 10,000 units at the rate of Chinese yuan 500 per unit. The price of the unit is expected to rise at the rate of inflation. So variable operating costs are 40% of the sales. So whatever will be the sales, 40% of that will become variable cost. And understand, this price of 500 rupees per unit will increase at the rate of inflation, which is 8%. Okay. So this is 500 today at 0 point. This is at 0 point. For the first year end, it will become 500 into 840 rupees, 540. And then again 8% for the second year. Okay. Current, see, at 0 time, current fixed cost is 22 lakhs per year, which is also expected to rise at a rate of inflation, which is 8%. Okay. So there are two things, almost all the things, like selling price, variable cost and fixed cost, everything is increasing at 8% per annum. The tax rate applicable in China for business income and capital gain is 25%, and as per Government of India policy, no further tax shall be payable in India. That's good. Current spot rate is 9.5 rupees per Chinese yuan. Nominal rate of interest in India and China is 12% and 10%. See, this is the Chinese rate of 10%, but this is not applicable for discounting, since we have not raised the funds from China. We have raised the funds from Mauritius, and the issue cost of this is different, which is I think somewhere 10.28%. Let's see, respectively, and the international parity conditions hold. You are required. Why do we need international parity conditions? For calculating the forward rates according to purchasing power parity theory. Identify expected future cash flows in China and determine NPV of the project in Chinese yuan. So this is very simple. The first part, you do not have to convert anything in other currency. No exchange rate is required in this case, because you have to calculate the future cash flows in China and NPV in Chinese yuan itself. Second part is a little different. So let's first find out the answer to the first part. NPV, we have to calculate NPV. Now, do you understand few things? in this question. So there will be sales, there will be purchases, contribution, less fixed cost. Do you understand this? And one more thing, less depreciation also. This is going to be profit before tax. Profit before tax, you will pay tax for both the years. This will be profit after tax, and then you will add back depreciation because that was the only non-cash item to make it a cash flow after tax. Apart from that, see, apart from all these, in the initially there will be an investment of two things. You can see land 30 lakhs and office complex 15 lakhs. So land 13, office 15, but they will be sold at the end. So if once they will be sold, you will receive 33.75 for the lands that we have calculated, and if you will sell the complex, 3.75 will be received after taxes. Now these are the total cash flow, XXX. Discount it at the cost of GDR that we have calculated, and you will get the NPV. That's it, simple. What else is there? Which cash flow has been skipped by us? The one thing that you need to make sure is selling price, purchases and fixed cost is increased by the amount of inflation. Let's first find out the cost of capital. I think I have missed out on this thing. Yeah, there was a mistake from my side in calculating the cost of capital. What I did, I will tell you. A little mistake only. We took the market price of 5 shares, but we forgot to take the dividend of 5 shares. So either you take the dividend of 1 share and 1 share's market price, or you increase the dividend here for 5 shares. So that's the mistake that we did, and that's why the market, the cost of capital was wrong. So we need to change it. Let's make it 200 rupees less 1%, that's 198. Let's make it for per share. So 2.5 into growth divided by 198 plus 0.10. It will give you 2.75. That's nothing but 2.50 into 1.10. 198 at the denominator and the growth. So that will be 11.39%. 11. Do you agree with this now? So that was the mistake in our calculation. Now we have the cost of capital. This is what we are going to use for the purpose of discounting. Now what else? Nothing, sir. See, this is the exchange rate that they have calculated using the nominal rate, interest rate parity theory. See, exchange rate is 9.50 today. So once you apply the interest rate parity theory, 9.67 for first year, 9.85 for second year. You can easily calculate that. We have done such calculations in the previous questions as well. Then this is about the land of tax, 33,75,000. I told you, sold at 35, purchased at 30, capital gain 5 lakh, taxes paid. In case of disposal of office complex, it's 3,75,000. Sold at 5 lakh, WDV was 0 because we depreciated everything. Capital gain was 5 lakh, tax was 125, and this is the amount realized. And then the computation of annual cash flows. Have a look. You are going to sell 10,000 units every year. What will be the price? It was 500 today. So 500 into 1.08 will become 540. It will increase by the rate of inflation. That's what is written in the question. So at 0 point, the rate is 500 selling price. So it will become 540 at the end of year 1, and again multiplied by 1.08 for the second year, it will become 583. So at these prices you will sell, multiplied by the quantity, you will get annual revenue less 40%. Variable cost is 40%. 40% of these sales will be the variable cost. Then less depreciation. See, there are only 4 items I told you in this diagram as well. Sales, purchases, fixed cost and depreciation. Right. So we have the total revenue, sales, purchases, depreciation and fixed cost. So depreciation value does not get affected by the inflation because it is not a cash flow. Okay. Variable cost. Now fixed cost. See, fixed cost was also like 22 lakh or something now. Let me just check once. See, the fixed cost was 22 lakhs and currently. That means it will also increase by 8%. So let's say it is 22 lakhs at 0 time. Increase it by 8%, 1.08, you will get 23 lakh 76,000. Again multiplied by 1.08, you will get the next year's fixed cost, second year's. And this is how you have arrived at PBT. Is this the end? No, sir. We have to calculate cash flow. What exactly we are expected to do? Deduct tax out of this, calculate profit after tax, and add back depreciation. See on the next page. We deducted tax, profit after tax, added depreciation, and this is a cash flow. So this is the cash flow that we are going to discount. Now, this is the last calculation, computation of NPV. In the beginning, you paid 45 lakh rupees, 45, 30 lakhs for the land, 15 lakhs for the complex. In the beginning, you paid this much, and these are the cash flows for the first and second year. But apart from that, these are the annual cash flows, now operational cash flows we can say. But apart from that, you sold the land for which you received 33 lakh 75,000 at the end of second year, 3 lakh 75,000 for the complex at the end of second year. I told you this figure, these two, right? Now this is the total. You will discount it at 11.39%, which is the cost of GDR. Understand that 10% Chinese rate was also given in the question. Since we are discounting Chinese yuan, 10% would have been the rate. But the entire funds are not raised in China. We have raised it from Mauritius, and the cost of that GDR was 11.39%. So what rate is most appropriate? The rate at which we have raised the funds or the normal rate? 11.39%. That's what we have used. Present value of the cash flows and then the NPV. It's very simple. NPV is negative. You can reject the project totally. But now come over to the second part. I think this was very easy for you. The second part says determine whether Opus Technologies should go for the project or not, assuming that neither there is any restriction nor any charges or taxes payable on the transfer of the funds from China to India. What if on the respective years the funds are transferred to India and then discounted at Indian rate of 12%? What if? Because they are saying there is no restriction first of all to transfer the money, and there are no taxes also payable in China or India for the same. So you transfer the funds to India on the respective dates. You know the spot rate, right? You have already calculated the forward rate for the first and second year in this calculation using interest rate parity theory, and question is very clear that interest rate parity conditions hold true. That means whatever you are going to calculate through interest rate parity theory, consider them as the actual rate as well. So these will become the actual rate. At 0.9.50 for the first year, 9.67 for the second year, 9.85. Now try to convert these cash flows. Just a second. See, these are the cash flows, these three, net cash flows only. So you take these cash flows here and try to convert these cash flows with the respective exchange rate in terms of rupees, and once it is calculated in rupees, discount it with the Indian rate, the rupee rate, and see there is a net present value of 8,670,000. That means when your requirement is to earn 12% in rupees, you are making a good profit. But when your requirement is 11.39% on Chinese yuan, then you are making a loss. But that doesn't mean you will end up making a loss. It means that the Indian rupee is is getting weak, is weaker. See, 9.5, 9.67 and 9.85. So it is weaker. It is getting weaker every year, and that's why we are making a profit, ending up with a more cash flow. Because we are an exporter, we will sell these foreign currencies to the bank at a higher rate because of the depreciation in rupee, and we will get more rupees in that case. So that's what his question is. Acha, there are two alternatives given to this. First alternative, which I prefer, you should go with this only, and that is when transferred in the year in which same are generated. That means in the first year we have generated 835 500 Chinese yuan. It was transferred in the same year. That is what we have assumed. each year's cash flow is transferred in the same year. But what the second part has assumed is that you have transferred the entire cash flows in the second year only. So they have taken 0 and 2 only. First year's cash flow has been kept in China itself. In this case, in this assumption, in China itself, and after it was transferred back at the end of second year with the second year cash flows. I think that is not proper, because you are losing out on the opportunity cost for 1 year. In that case, the NPV is little less. NPV is little less. So though in terms of Chinese yuan, the NPV of the project is negative, but in terms of rupees, it is positive. Why? Due to weakening of the rupee in comparison to Chinese yuan. Thus, we can accept the project. Easy. In entirely what we are doing in every question now, and we will be doing in the every question coming, we are going to calculate NPV, net present value, and we are going to make sure if we are discounting foreign currencies, the discounting rate should be foreign country discount rate. If we are discounting home currency, then the discount rate should be related to home country. That's it. Okay, this is another question, again an interesting one, on a similar note which we have seen, but we are going to enjoy this. Let's take a break once, and I'll be back with question number 14 then. See you. Okay, so welcome back. Let's have a look on this question. This is a this is an easy question. Question number 15 will be little difficult, we can say, but this one is little easier than the 15, and 14 and 15 are quite similar. Let's have a look. A US company wants to set up a manufacturing plant in India. A US company wants to set up in India, right? So a foreign company is coming to India for setting up the plant, which requires an initial outlay of 8 million. So start your visual memory and create a timeline in your mind. In the very beginning, there you can see an outflow of 8 million rupees. It is expected to have a useful life of 5 years with a salvage value of 2 million. Okay. The company follows a straight line method of depreciation. So in this case, the depreciation will be 8 million of the cost minus 2 salvage value, initial cost minus salvage value divided by life. So 6 by 5, that is 1.2 million every year will be depreciation. To support additional level of activity, investment would require one-time additional working capital of 1 million. What is the working capital? Working capital is like current assets and liabilities. You put money in the beginning at time 0, and after the end of the project, that working capital gets released. So it is showed as outflow in the beginning and inflow at the end. This is not an expense. Working capital is not an expense. It will be recovered back at the end of the project. So this 1 million will be outflow today, and at the end it will be inflow. Today, if you see in that visual memory of yours, the timeline, today outflow of 8 million is there. This plus 1 million of working capital. So total 9 million is going out. Since the cost of production is lower in India, the variable cost of production would be 30 rupees per unit, and additional fixed cost per unit per annum will be estimated at 0.5 million. That's 5 lakh rupees. The company is projecting its annual sales at 80,000 at a price of 100. So 100 is the selling price, 30 is the variable cost, right? So 70 will be contribution, into 80,000 will be total contribution, minus 5 lakh will be the fixed cost, and minus depreciation of 1.2 million, that's 12 lakh. So this is how you have to imagine. Sales minus variable cost is equal to contribution minus fixed cost minus depreciation will be equal to profit before tax. Okay. Applicable tax rate is 34% and the cost of capital is 8%. Inflation rate in US and India are 8 and 9% respectively. The current exchange rate is 72 rupees per dollar. Now please understand, if you think from the US company's point of view, this is indirect quote. But if you think from the Indian perspective, this is a direct quote. My opinion to you is go from the US company's point of view and consider your home country as US and consider India as your foreign country. In that case, this quote becomes indirect to you. Okay. And RD will be 8%, the US rate, RF will be 9%, the Indian rate. And in that case, because the quote is indirect, you will write down 1 plus RF by 1 plus RD is equal to F by S in order to calculate the forward rates for each year. The current exchange rate, how many years this project is going to work for? 5 years. So for 5 years, you are going to calculate the forward rates. Current spot rate is 72, right? So you put 72 at place of spot rate and keep putting 9% and 8% as the inflation rates. And I think this is inflation. So we are going to use in purchasing power parity theory, IFRD. Answers will be same. So by using purchasing power parity theory for indirect quote, you are going to calculate the forward rates for the next 5 years. Assuming that all the profits will be repatriated every year. See what is happening. Every year the rupees will be transferred back to America. Repatriation is from India to America. There will be no withholding taxes. Estimate the NPV of the proposed project in India and evaluates its feasibility. Present value factors for 8% are given. 8% is given to you. Let's have a look on the answers. What can be done? Let's try to frame few things here. See, you have to visualize a lot of things in this type of question where the size of the question is big and you tend to forget what you have read in the very first line by the time you reach the end of the question. So in all the cases, what you can do is to simplify your answer or question by dividing all the cash flows in 3 different manner, 3 different position. This is called as initial cash flow. This is initial cash flow. This is operational cash flow for all the 5 years. And this is terminal cash flow. Now, everything will be easy for you. Initially, you are going to pay 8 million, that means 80 lakh rupees initial outlay. Again 10 lakh rupees for working capital. So the total outflow is 90 lakhs. Now, when you come to the operational part, you can see you are selling 80,000 units at 70 rupees of the contribution. So selling price is 100, variable cost is 30, contribution is 70, total quantity is 80, and thus the total contribution becomes 56 lakhs. Let me just calculate once. Yes. And see, there are only, most of the time there will be only 4 things: selling price, variable cost, fixed cost, and depreciation. Now, fixed cost. What is the fixed cost in this case? 0.5 million. That means 5 lakh. That's 5 lakh. And what is the amount of depreciation that we had calculated? 12 lakhs. That's 39 lakh. Profit before tax. Then you are going to deduct the tax out of it, which comes to 34%. So less 34, that will give you around 25 lakh 74,000. And this is just profit after tax. You will add back depreciation in that, which was 12 lakh rupees further. So this is 37 lakh 74,000 every year for the next 5 years. Okay. So this is the cash flow. Now coming over to the terminal cash flow. You are going to sell this for 20 lakh rupees. So you will receive 20 lakhs. Since you are depreciating it on a straight line method, there is no capital gain in that case. And this is the working capital. This was not the expense. You will release it back at 10 lakh. That's it. These are the only cash flow. I'm just marking them. These 5 are the only cash flow. But the question is not that simple. All these cash flows that I have written are in rupees. What you have to do is calculate the forward rate for each point. 0, 1, 2, 3, 4, 5, 6 exchange rates has to be there. And all the cash flows will be converted in terms of dollars. because my home country in this question is America, and these cash flows are in rupees, which is a foreign currency for me. So I'm going to convert rupees into dollar and then discount it at the relevant discount rate. That's it. Easy. Let's complete it. So the initial investment is 80, 10, 90 lakhs. Done with it. Now, converted that at the spot rate, which becomes the initial investment in dollars, which comes to 1,25,000. Then the expected exchange rate for all the 5 years using purchasing power parity theory with 9 and 8% of the inflations. Okay. So you will come up with this spot rate and then 1, 2, 3, 4, 5. So this 37,74,000 5 times will be converted into dollar at a different figures. You will get a different figures for that. Annual cash flow, sales, variable cost, additional fixed cost 5 lakh, depreciation 12 lakh. I told you, profit before tax, less taxes, add back depreciation, it comes to 37,74,000. Now this 37,74,000 each year will be written like this and will be converted at these exchange rate to dollars because it was in rupees. Now, last, it's that easy. Just a second. At the end, you will release the working capital. So 10 lakh rupees you will receive, and the 5th year exchange rate is 75.40. So the dollar value of the working capital released will be this much, 13,262, and you will get the salvage value of the project, that's 20 lakh at this exchange rate. Amount is this much. And now NPV of the project, initial outflow, everything will be written now in dollars in our home currency. Our home currency in this question is dollar. So write down everything in dollar. All the annual cash flows converted in dollars. All the annual cash flows converted in dollars. There is one mistake, printing mistake here, that nothing is printed in this row. So please ensure that this 13,262.60 of the working capital is written over here. And since it is in the 5th year, it will be discounted with 0.681 and the value will be this much. So please write it down in your book as well. This is the release of working capital and the salvage value. Initial outlay is released here in terms of salvage value, and release of working capital NPV in terms of dollar is there. That's it. 8% is the dollar discounting rate. Simple. All these 5 cash flows has to be converted in dollar and then discounted at 8%. You will get the NPV. This is the end of the question, sir. This question was asked in December 21 for 8 marks. See, answer is very easy, but what will happen, I will tell you. Since it will take time to write down this much of the answer, there are chances that you will end up making some mistakes. The more you write on a particular question, the more are the chances that you will end up making a mistake. Like in place of 74.02, what if you write 74.56 or anything, 20. In place of 02, you can end up writing 20, and all the answers will become wrong after that. And you will get 0 marks. That's where you cannot take the chances. Even though the question is easy, if the answer is long or large, you need to make sure you can put it for the end of the question paper. Okay, sir. Question number 15. Now, have a look. A US based company, again a US based company. In the previous question, it was also the same, is planning to set up a subsidiary company in India, where so far it was exporting. Till now, US company was exporting goods to India. But now, since there is a huge demand from India, I think, they are planning to set up a subsidiary in India itself, produce there and sell it there. In view of the growing demand for its product and competition from other US based companies. So the demand is increasing, that's why we are planning to set up a subsidiary there. Initial project cost consisting of plant and machinery, including installation, is to be US $490 million. So this is the initial cost. See, this is a timeline. $490 million at this place. The net working capitals, let's say plant and machinery 490. Net working capital requirement. Working capital is not an expense. It will be deployed in the beginning and released at the end. So it is $60 million. So 60 million in the beginning. Working capital 60 million. Company follows straight line method of depreciation. Currently, the company is exporting 2 million units every year at a price of 90 and a variable cost of 50. So we can say 40 rupees is the contribution and 2 million units every year they are exporting. What will happen in this question? There will be two things given in the there will be one thing that will be asked to you in the at the end of the question. Should we go for setting up the subsidiary in India or not? And in that case, the NPV of setting up a subsidiary will have to be compared with the NPV of the current business. That means exporting the goods to India. So what if we export the goods to India? Consider all the cash flows, inflow, outflow, discounting, present value. Then what if we set up a subsidiary, inflow, outflow, discounting, present value? And then compare and then decide. Okay. So currently the company is exporting 2 million units at 40 rupees of the contribution. CFO of the company has estimated the following operating cost and other data in respect of the following project. Variable operating cost will be $30 per unit of production. Production in India. Okay. Right now it is $50. If you produce the goods in US and export it to India, it is costing you $50. Now it will cost only $30. I think what we can do is, so this is like subsidiary and this is export. So the very first thing is selling price, variable cost, quantity. So variable cost, I can clearly see it is $30 if we produce the goods in India, and it is $50 if we produce the goods in US and then export it. Okay, what else? Selling price in export is 90. So let me write down 90 is the selling price in case of export. And okay, initial project cost, working capital. So this is it will be written here 490 and 60 million in case of subsidiary, planning a subsidiary. What else? Okay. Now, additional cash fixed cost will be $30 million per annum, and project's share of allocated fixed cost will be $3 million per annum based on the principle of ability to share. Understand? This is related to subsidiary. Okay. And this is the cash fixed cost, which will be $30 million. So I will write down fixed cost, $30 million. And I am ignoring this $3 million because $3 million is just allocated fixed cost. This cost will be incurred even if you do not set up a subsidiary. So this cost is not incurred because of the subsidiary. Your decision to incur this cost will not change if you do not set a subsidiary or if you set up a subsidiary. This is just because you have set up a subsidiary, they have transferred some share of expenses that they are already doing to the Indian subsidiary, which is not a cash flow. It is just an allocated expenses. So this will be irrelevant for the purpose. This is called as irrelevant, or we can say irrelevant cost. You will learn about this in I think you have already learned about this in intercosting or like this. Expected useful life. This is also related to subsidiary. Expected useful life of the proposed plant is 5 years with no salvage value. So this is also related to subsidiary. If the salvage value is nothing, that means 490 divided by 5 will be the depreciation. So every year the depreciation will be 90. This is not 98. This is not cash flow. Tax saving on depreciation will be a cash flow. Production capacity of the proposed project in India will be 5 million units. This is also related to subsidiary. See, the quantity is 5 million when you set up a subsidiary and 2 million when you export the goods right now. Existing working capital investment for production and sale of 2 million units through export was 25 million. This is export related information. Existing working capital investment for production and sale of 2 million units through export was $25 million. So understand, actually you are not required to invest $60 million if you set up a subsidiary. You can just release that 25, use that 25 here, and the additional cost will only be 60 minus 25. That's 35 million only will be required if you calculate on the basis of incremental approach. Incremental approach will give you an idea of the extra cash flows required in the subsidiary. So in this case, incremental is 3 million units, but the pricing is different, I think so. It will vary. But for the working capital, we can say only incremental that we need to consider is $35 million, because $25 million is already booked in exports. If you set up a subsidiary, that 25 million can be transferred here. So that's not an additional cost. And we can invest 35 million more for the working capital. Okay. Export of the product in the coming year will decrease to 1.5 million units, provided the company does not set up a subsidiary company in India. In view of the presence of the competing other US based companies that are in the process of setting up their subsidiaries in India. See, all in all, the meaning of this is, if you do not set up a subsidiary in India, other companies of US are setting up a subsidiary in India, and because of this, the competition will grow, and ultimately you will end up selling less number of units through export. If you continue the export, you will not be able to sell 2 million units now. It will only be 1.5 million. So remember that. It will only be 1.5 million that you can sell through export if you continue with that. Okay. So this is again an information related to export. Applicable corporate tax rate is 35%. Cool. Required rate of return on such project is 12%. Cool. Assuming that there will be no variation in the exchange rates of the two currencies and all the profits will be repatriated. No variation means you do not have to worry about conversion. Exchange rates will be similar. And all the profits will be repatriated, no withholding taxes. Estimate the net present value of the proposed project in India and give your advice. Present value factor at 12%, which has to be used, is this only. The present value factor given in the question should be used by you only. So do not be very smart at this and calculate your own present value factor. Institute has given you the present value factor so that everyone's answer should be same. And if you end up taking 0.893 instead of 0.8929 here, you will get a wrong answer or different answer, and institute will cut the marks. So all in all, this is the scenario. What are you going to do? It's very simple, sir. You can do the calculation on the basis of incremental approach, and that will save up on your time, but that is difficult to understand. Or you can do your calculation based on export separately and subsidiary separately. I am going with the incremental approach, which will take some time or take some efforts, but it's easy to understand. It will be very good to save time. Okay, sir. I think selling price is same for both. Selling price is same for both. So can I say the variable cost is different now? Okay. So can we conclude that the contribution is different at least? See, I will divide all the cash flows in 3 parts. Initially, I will pay 490. Okay. and 35. I'm doing the calculation on the basis of incremental approach, that if I close the subsidiary and go for the, if I close the exports and go for the subsidiary, what are the additional cash flows that I will have to incur? So this is incremental approach. Now you look at this. So 35 only you will have to invest in working capital, initial cost entirely 490. Okay. Now, additional fixed cost is 30 lakhs. Let's go for the sales. Again, there are four things in sales: selling price, variable cost, fixed cost, and depreciation. You get it? Now, selling price and variable cost and quantity. If you go with that, you realize that, let's say the contribution here is 60 and it was 40 in that case. 60 multiplied by 5, that means you can make a sale of $300 million, and in this case you can make a sale of $60 million only. So the additional sales is 240, that you need to consider only, because out of 300, 60 is so you can make it without setting up a subsidiary as well. So what is the benefit of setting up a subsidiary? 240 millions extra sales. That's the benefit of setting up a subsidiary. Okay. And fixed cost you will deduct, depreciation you will deduct, you will calculate the profit before tax, then you will deduct the tax, profit after tax, add back depreciation, then convert it into cash flow after tax for 5 years, discount it, and you will get the answers. I think everything is fixed now. Have a look. See, incremental approach. Institute has also followed the incremental approach. So 490 is the outflow. Look at the answer from the angle of closing down the, or we can say what is the extra benefit from exports for setting up a subsidiary. 490 is the investment required if you set up a subsidiary. Working capital required is 60, but the release of working capital from the exports will be there. So exports working capital of 25 will be released. So out of 60, 25 will be used in there and 35 only be required. So 490 plus 35 will become $525 million. Cool. This is initial investment. Let's go for the generated by investment in India for 5 years. Yeah, right. See, sales revenue 5 million into 90 less cost 5 million into 30. So they are doing it like this, na? It's okay. See, I told you 240, I will take 240 here. Incremental contribution less fixed cost of 30 less 98 of the depreciation. So 240 less 30 less 98 becomes 112. I think they have calculated the tax also, na? Chalo, I will take the tax as well. Less 35% tax, that's 72.8 plus add back depreciation 98. 72.8 plus 98 goes to 170.80. So the total should be somewhere like this. Now have a look. Incremental cash flows we are going to calculate. So if we set up a subsidiary, sales, variable cost 5 million into 90, 30, fixed cost, depreciation 98, you can clearly see fixed cost is 30. So the net profit is 172 only from the subsidiary. Taxes, earning after tax, add back depreciation. So the net profit is, cash flow after tax is 209.80. Now from export, what was happening? From export, it is 1.5 million at 90, 1.5 million at 50, selling price, variable cost. There is no other cost in this case. This becomes contribution before tax. You pay the taxes and this is the cash flow after tax. Now you compare this one and this one. Without subsidiary, you are already generating a cash flow of 39. With subsidiary, you will be generating 209.80. So what is the incremental? 39. That's 209.80 minus 39 comes to 170.80. That's what we have calculated here. So if you go with the incremental approach or you go with this approach, it's the incremental thing that only they are considering. So see, 170.80. So we have reached at two values: initial cash flows. Let me just find out. Initial cash outflow of 525 operating cash flow of every year for 170.80, and terminal cash flow of the release of working capital. See, and the answer is here. For 1 to 5 year, 170.80 at 12% the annuity factor, and in the 5th year, $35 million of the extra working capital will get released at the discounting rate, and initial cash outflow 525. We can see that 1 2 3. See, 525 paid here, every year 170.80, and at the end 35 working capital released. That's it. So you go with the incremental approach, you will get the same values 35 for 90. Since NPV is positive, the proposal should be accepted. See, this is the NPV of closing exports and going for the subsidiary. So the NPV shows that how much incremental or extra cash flows we are going to receive by setting up a subsidiary. So if the cash flows are positive, that means we are earning more than export, and if it is more than export, go with the subsidiary. NPV is positive. Got it? So this is how you have solved this question. Question number 16 is going to be the next question. 16, 17 and 18 are going to be a big one. So you need to be very careful with this. Have a look. Question number 16. I think till now all the questions like were pretty manageable. Not that difficult to understand. Now is the time to see what happens. Question number 16. Have a look. Perfect Incorporation is a US based pharmaceutical company. Third question continuously, where a US based company is coming to India. Perfect Incorporation, a US based pharmaceutical company, has received an offer from Edscure Limited, a company engaged in manufacturing of drugs to cure dengue, to set up a manufacturing unit in Baddi, Himachal Pradesh, India, in a joint venture. So this is a kind of a joint venture between Perfect Incorporation and Edscure Limited. So there will be something like Perfect Incorporation will do all the investment and all, and Edscure Limited will work on that. So both of them has come into a joint venture. As per the joint venture agreement, Perfect Incorporation will receive 55% share of the revenues, plus a royalty of $0.01 per bottle. The initial investment will be 200 crores for machinery and factory. Let's start writing because otherwise we will miss out. So initial investment done by only Perfect Incorporation. Edscure Limited is not contributing anything into the initial investment. So if entire investment is done by the Perfect Incorporation, the depreciation will only be charged by the Perfect Incorporation. Edscure Limited cannot take depreciation as their expense because they have not contributed anything in the initial investment. Have a look. The initial investment will be 200 crore for machinery and factory. The scrap value of this machinery and factory is estimated at the end of 5 years to be 5 crore. See, 5 crore at the end of 5 years. Okay. Then the machinery is depreciable at 20% on the value net of salvage value using straight line method. So what are you going to do? 200 cost of machinery minus 5 crore salvage value divided by 5. Why divided by 5? Because when you divide 1 by 5, the 20% is the rate. So 20% is calculated based on that. So 200 minus 5 divided by 5, 39 crore. So this is a part of operational cost, 39 crore depreciation. This is just for the purpose of calculating or saving taxes. Now, $205 crore. Okay. An initial working capital to the tune of 50 crore shall be required, and thereafter 5 crore each year. See, now the working capital, how it is going. Working capital of 50 is required initially. Okay. Yeah. And then what will happen? 1, 2, 3, 4 and 5. You will invest 5 more crore here. Outflow is 5 only, na? Every year 5 extra crore is required. Thereafter 5 crores each year additional. That means by the end of year 4, you will have a total of 70 crores in a working capital, because this is not an expense. So this will keep on adding. It will become 55, 60, 65, 70 here. And you will release all the 70 crore at the end of 5th year. Now you might ask a question, sir, why there is no cash outflow of 5 crores at the end of this 5th year? You can do that. You can write down -5 also. It will become 75 and it will be released at the same time. So what's the point of paying 5 crore and receiving 75 at the same time? The total of this becomes 70 itself, na? So that's what I am taking. This is the flow of working capital. Okay. And it will be released at the end. As per Government of India directions, it is estimated that, please understand, as per Government of India direction, it is estimated that the price per bottle will be 7.50 rupees and production will be 24 crore bottles per year. The price in addition to inflation of respective year shall be increased by 1 rupees each. The price will be increased by 1 rupees plus the inflation of every year. So just understand what is going to happen. 7.50 plus 1 rupees plus inflation. We'll look at that. The production cost shall be 40% of the revenue. And see, as per this joint venture agreement, 55% of the revenue will go to Perfect Incorporation and a royalty of $0.01 on every bottle. So the price in addition, okay, 40% is the revenue. Applicable tax rate in India is 30% and 35% in US. And there is a double taxation avoidance agreement between India and US. According to the agreement, tax credit shall be given in US for the tax paid in India. So first the India will pay 30% tax, and then US we will calculate the 35% liability of America, and out of that liability first we will get the credit of this 30% tax paid in India, and then the balance tax will be paid. I'm telling you, this question is going far ahead. Like, never solve this question in exam. That's my personal suggestion. You will not be able to finish this within an hour and without making mistakes. According to the agreement, the tax credit shall be given in US for the tax paid in India. In both the countries, taxes shall be paid in the following year. Now, this is another thing. This is going to make everything worse. What will happen? The taxes has to be paid for this year. The taxes will be paid for in the next year. That's what the question is saying. In both the countries. So, you will calculate the liability for this year, but the outflow of this year will be shifted to the next year. Bad, very bad. In which the profit have arisen or remittance received. Spot rate is 57 rupees per dollar. Inflation in India is 6%. Again, the inflation is expected to decrease by 0.50% every year in India. So basically it will be like 6, then 5.5, 5, 4.5, 4 and 3.5 like this. Too much of headache. But in US it will be 5% for all the years. As per the policy of Government of India, only 50% of the share can be remitted in a year in which they are realized and remaining in the following year. So whatever the amount you calculate for remittance to America from India, only 50% of that you will transfer in that year and the balance in the next year. Every condition is going like asking us for a lot of calculation. The WACC is 13%, but due to the risky nature, it expects a return of 15%. So we will go with the 15% required rate of return. Whether we should invest in the project or not. Too much of a task. I will show you. So first of all, obviously, like looking at the answer, I'm telling you one thing, please understand. Looking at these answer, everything will seem perfect to you. But try to solve this on a blank paper. It will take almost 1 hour and still you will not be able to finish it. That is going to be a huge, because every sentence is asking for a big calculation. Have a look. I am going only with the answer given in this question because my purpose is to explain the answer, not to spend time in writing each and everything right now in the fast track batch at least. So we are going to calculate the exchange rate using purchasing power parity theory. Let me just show you how we can do that. 1 plus RD 1 plus RF F by S. But please understand, in the first year you will take 6% and 5% F by S will be 57. In the second year you will take 5.5% and 1.05 F by S will be there. In the next year you will take 1.05 and divided by 1.05 F by S. So you can see in the third year the rates are same, because by decreasing 0.5% the numerator and denominator is coming to same, like 1.05 divided by 1.05, so that's 1. So spot rate will become the forward rate for that year. See, 57.82, 57.82. That is what is happening. And you will calculate it for 6 years. Sir, why 6 years? The calculation is only for the life of the project is only for 5 years. No, sir. Because there are some cash flows of 5th year which you will transfer to your country in the next year. 50%. That's why. So for all the 6 years you have calculated the exchange rate. Now coming over to the sales. It's very simple, sir. Just keep in mind 24 crore units you are selling every year at a price of this. Now, first of all, increase the price by 1 rupee. Okay. And then put the inflation rate here. Increase the price by 1 rupee and then put the inflation rate 6, 5.55, 4.54. Because this is the price in rupees, inflation of Indian currency will be required, which is going to decrease by 0.5% every year. And add that percentage here. This will become inflated price. This will become inflated price of the respective year. No indexation will be covered here. Okay, forget about that. Inflated sales revenue will be this. So inflated price plus multiplied by annual units. So this is the inflated sales revenue. But look at from the angle of the perfect incorporation. He is not going to get the 100% of the sales revenue. Only 55% of that will be transferred to the perfect incorporation. So my share in sales is this much only. Okay. This is the calculation part. Now royalty 24 crore units. On every bottle I am getting 0.01. Okay, so total royalty becomes this one, but that is in dollar. I am getting $0.01. So in terms of rupees, we can calculate that by putting exchange rates here. So put the exchange rate here and you will get the rupees royalty in crore. So this is the royalty perfect incorporation is going to receive. This is the share that he is going to receive. We can add both of them. See, sales share, total royalty. Good. If you are taking a share in the sales, you will have to bear the production cost as well. That's 40%. Sales share. See, automatically I am taking only 55% of the share here of the sales, right? So if I calculate the production cost of as a 40% of this, that means I am also considering 55% of the production cost only for perfect incorporation. Rest of the production cost will go to Edscure Limited. So there are only four types of income and expenses: sales and royalty, production cost, depreciation, and there will be, I think, fixed cost. Depreciation will be 39 every year. Inflation does not affect the depreciation. That's why it is same. See? Okay. And please understand, production cost includes the inflation. All these prices in this row includes the inflation. How? Because this is calculated based on the sales, and sales was already calculated using inflated price. That means this also includes the inflation part. Now, this is the profit before tax and tax on a profit. This is the tax on a profit payable in India, but in the next year, not in the first year. So if this is the tax for the first year, it will be paid in the second year, in the following year. That's what the question was. And I think we have not taken, is there any fixed cost? I don't think so. Okay, so there is no fixed cost. Now let's calculate. This is the net profit, which is not that required. Net profit is not required. Now again we are going to calculate the cash flows. See, understand what is happening now. You will start from 0. You will add this one and you will add this 2 columns, 0 and 6th year. Now what will happen? You take the sales of the share, royalty, okay, then production cost. These three will be same. Okay. initial outflow and working capital here, and see, you can see working capital every year they are increasing, and then 70 is being released at the end of 5th year. Cool. Scrap value at the end of 5th year 5 lakh, 5 crore or 5 lakh, I think 5 crore. Total investment was 200 crore, 5 crore was the scrap value. And tax on a profit. Now understand, tax on the profit for first year was 11.33, but now I am writing it in the second year. Can you see that? I am writing it in the second year because cash flow of that tax is happening in second year. It was the tax for the first year, but I am paying it in the second year. So that's why cash flow is taken in the second year. That's what the question was, that it will be paid in the following year. And what will happen for the 5th year tax? 5th year tax was 20.82, which will be paid in the 6th year. And that's why we have to write down this column of 6th year. See, nothing is there in the 6th year except for this tax. So this is the cash flow that will happen. But I cannot transfer the entire cash flow to US. Only 50% of the profits will be transferred, or the cash flow will be transferred to US in that year, and the balance 50% in the another year. So remittance of cash flows now. This is making difficult now. This is the free cash flows taken from the above. Now what will happen, I will tell you. 50% of this will be divided in two parts. 50% here, 50% in the next year. 50% here, 50% in the next year. This is how we have shifted all the cash flows. So in the 5th year also, 164 will be divided into two parts, 50% here and 50% here. Now in the 6th year, there are two things. Understand, the tax 20.82 for the 5th year and the 5th year's remittance. And because we are going to do the total of it, now the cash flow is coming to positive 61.62. So this is going to be the total remittance in that year. Now this is still in rupees. We are remitting it to America. We have to convert that in dollars. So we'll put that again here. Take the exchange rates for every period 0 to 6. Convert that remittance into dollar. Once this remittance, this amount will go to America, we will have to pay 35% tax on that in the next year. So understand, 35% on 6.24 in the next year, 2.18. Getting it? Because in both the countries, tax of a particular year has to be paid in the next year. So 6.24, the cash flows that has, this is the complicated and ambiguous part, because 6.24 is the remittance that we are transferring to the to America, and tax in this question has been calculated on the remittance and not on the exact profit. So that becomes, here the calculation becomes difficult and you can debate on that, and your point is also valid, but we cannot help it. Question will become a lot, like it's better to leave that question instead of studying it. It will be like that in that case. Okay, so see what happens. So we have calculated the tax on the remittance, that is 35%, and written it in the next column. That means we are paying it in the following year. But this is yet to be paid. Please understand. We will get the credit of the tax paid in India. Now we have paid the tax in rupees. This particular figure. Okay, 11.33. We have to convert that in terms of dollars. See. So when you convert that in dollars, Indian tax, it will be 1.96. I will show you how. There is some problem in this as well. 11.33 is in crores. Do you get that? So before converting it, you have to convert that crores into millions. So it will become 113.30. Now this is in millions. Now divide it by exchange rate. Exchange rate of second year, I think 57.82. And the answer will be 1.96. Do you get that? So first, Indian tax will be converted from crores to millions and then divided by the exchange rate to arrive at 1.96. I will show you. 11.33 into 10 divided by 57.84. So this is the calculation of 1.96. Crores of tax is converted into millions and then divided it by the exchange rate of that period, 82. Let me just do the calculation. This is 57.82. Okay, so this is the net tax that is payable only. So this is a cash flow, and sorry, I will show you. This is the remittance that they will receive, and this is the only tax that they will pay. This is just a calculation and not a cash flow. This is just a credit of the tax paid and not a cash flow. So this minus net of net tax payable will be deducted. So this will be net cash flow discounted at 15%, and then you can arrive at the present value. Very big. It's not that easy. We have finished it in 10 minutes, but if you write it on a blank paper, it's not going to be an easy task for you. It comes to negative and the project is rejected. After doing so much of the efforts, when we can see that the project is rejected, it hurts. Nevertheless, this type of questions are there. Like I told you, last questions are like that only. And I am very much dissatisfied or demotivated with this question number 16, because first of all, this is not, I think, asked in exam, so don't worry about it. It was asked in MTP November 21, MTP November 21, and study material till now. Less chances that they will ask this question in exam. Next question is very good. It was asked in the exam, so May 2019, and question number 18 is also big one. We'll see to that. Let's have a look on question number 17 now. Okay, so let's have a look on question number 17. This is the new question which has been added recently in the compiler, and there are some printing mistakes. So my sincere apologies for that. I will make sure all the corrections are dictated by me in this question. Answers are properly given. There are no changes in the answers. There is only, like, in place of rupees there has to be GBP, so that small changes are there. Have a look on this question now. K Limited currently operates from 4 different buildings and wants to consolidate its operation into one building, which is expected to cost around 90 crore rupees. So we are operating from 4 different buildings and we want to shut down everything and come to a single building. The entire operation will cost around, what has happened? Just a second. The entire operation will cost 90 crore to us. Okay. The board of K Limited had approved the above plan. That means now you need 90 crore to set up that one building. Obviously, for that purpose, you will need funds. To fund the above cost, agreed to avail an external commercial borrowing. That means we are not borrowing from India. We are not taking a loan of 90 crores from India. We are taking a loan from someone else outside India. And that is GBP 10 million from G Bank Limited. So this G Bank Limited might be situated in London, let's say. And they are ready to give us 10 million GBP. Now understand, 10 million means 1 crore. They will give us 1 crore GBP, and that will be converted at the rate of 90 rupees per GBP to 90 crore rupees. This is how we will get our 90 crore required. The rate will be 90 given in the question itself. Now, the loan will be availed on 1st April 2019 with interest payable half yearly rest. Okay. Average loan maturity life is 3.4 years with an overall tenure of 5 years. Now, this is very important to understand. Half yearly interest has to be payable, first of all. Second, in this question, if you calculate the half year interest payments and then you want to calculate the present value of all the interest payment, you will need to discount all the cash flows. But instead of doing that, institute has given, or the question has given us an alternative approach. You can take the average loan maturity as 3.4 years, full years. So even if you multiply 1 year's interest with 3.4, it will be as good as calculating the half yearly interest and then taking the present value of the same. So average loan maturity life of 3.4 will be used by us instead of 5 in order to consider all the interest payments along with the time value of money. Upfront fee is 1.20%. Interest cost is GBP. Acha, let's stop it here. 1.20% of 10 million, right? 123. Let's calculate. That comes to GBP 1,20,000. So this is the upfront fee that we will be paying. Okay. Second, the interest cost is 6 months LIBOR plus margin of 2.5%, and the 6 months LIBOR is 1.05%. That means 1.05, that means 3.55%. Now understand how to calculate the interest. It's very simple, sir. 3.55% into in terms of million or what? 10 millions. Just a second. Yeah. So 3.55 millions into, let me write down, 3.55% applicable on this loan of 10 million for 1 year and multiplied by 3.4. This will give you the total interest cost. Average life. That's around 12.07. Into 3.4, 12,07,000, right? Okay. Now, what's more to this? K Limited also entered into GBP INR hedge. That means a forward rate of 1 GBP is equal to INR 90 to cover the exposure on account of above ECB loan. And the cost of hedging is coming to 4% per annum. 4% per annum of 10 million into 3.4, again average life. That's 13,60,000 GBP. So I think three values are there as a cost. One is the upfront fee, second one is the interest, third one is the hedging cost. Upfront fee, interest, and hedging cost. As a finance manager, given the above information and taking the 1 GBP is equal to 90 INR, calculate the overall cost both in terms of percentage and rupee terms on an annual basis. So we have calculated it in GBP. We have to do it in INR. Question is clearly saying that calculate that in INR. So there is one way to calculate that in INR. Just take the total of all the three values and multiply it with 90. If the answers are right, let me just check once again. So 24, 18, 13. So there might be some calculation. We'll look to that. And first of all, calculate the overall cost in percentage and rupee both on an annual basis, right? On an annual basis divided by 3.4. Yeah, it's coming to exactly. Let's have a look. Upfront fee first. Just a second. There are multiple ways in which the answer has been calculated. Upfront fee 10 million into 1.2%, 1,20,000, and you need to make some changes here. This is not rupees. This is all pound, pound and pound and pound. That's what the mistake is. Pound. Okay. So 1,20,000 pound upfront fee. Interest payment, have a look, 10 million into 3.55% for 3.4 average years, coming to 12,07,000 GBP. And hedging cost, there are only three types of costs that we have to bear. For taking the loan, we have to pay upfront fee, then we have to pay interest on that loan, and if we are taking hedging also, then hedging cost of 10 million at 4% for 3.4 years. So that's 13,60,000. So this is the total hedging cost, 26,87,000 pound. Remove that rupees. Okay. Now In terms of percentage, if we want to calculate, it's very simple that the cost will be calculated on the amount that I'm getting to use, like the amount that I am allowed to use, or that amount I have received. The amount that I have received is 10 million minus the upfront fee. The fee will be charged by the bank itself, and in most of the loan cases what happens is that if I go for the ICICI bank for a home loan of 1 crore rupees, and if they are charging an upfront fee of 1 lakh, so I will only get 99 lakh in my bank account. They will cut that 1 lakh rupees straightforward. So I'm only using this much of the amount, 10 million minus 1 lakh 20,000 GBP, and on that I'm paying this much of the cost. The expense to me is this much. So this is the cash flow and this is the expense, 2.687 million, right? So in this case, this is for all the 3 years. You can clearly see this is for all the 3 years. So that's why I'm dividing it by 3, multiplying it by 1, and then by 100 to come to an overall cost of 8% per annum. 8% per annum. And if you want to calculate that in terms of rupees, it's very simple, sir. 2.687 is the pound. You can multiply it with 90 and divide it by 3.4. So 2.687 multiplied by 90 will give you rupees. See, this is the pound. When you multiply it with exchange rate, it will give you rupees, and then you divide it with 3.4. Just don't do this. Don't multiply it with 100. And the answer will be 2.687 multiplied by 90 divided by 3.4. So the answer will be 71.12647 millions. So it's not 7112.647 million. No, 71.12647 million. So almost 7 crore rupees, I think. 7 crore. So these are the two answers. I will just mark it. First in terms of rupees, 7 crore something, and one in terms of percentage, that is 8. But there is another way to calculate this one also. You can just wait. Overall cost in terms of percentage, you can calculate on the 10 million as well. According to me, this is not perfect. If you go and ask for the loan to the bank, then you will get to know. So you should deduct 1.2 lakhs upfront fee. But that's okay for the theoretical purpose. And that's why the cost is coming to 7.9% now. And if you calculate that 7.9% on 10 million directly and multiply it with 90, because this is in GBP, you multiply it with INR, you can get the same answer of 7 crore 11 lakh. 7 crore 11 lakh rupees as the cost. In this case also it was 7 crore 12 lakh rupees, 11 lakh 26,000. 7 crore 11 lakh 26,000. In this case it's just 7 crore 11 lakh. That 26,000 is just because of that 1.2 that you have not taken here. Another way to calculate that is through percentage. See, interest and margin that you are paying is 3.55% per annum. Hedging cost you are paying 4% per annum. Okay, one time fee that you paid 1.2% for all the 3.4 years. So that's why what you are doing is you are calculating one time fee for per year, that is 0.3435. So one time fee divided by average life 3.4, and you will get per annum one time fee. Per annum one time fee. So if you add this and this, you will get annual average cost in terms of per annum. So this is another way of calculating 7.9%. And if you apply that 7.9% on 10 million, 7 crore 11 lakh will be the total cost. So what the question is asking us in crux, they are asking us what is the total expense to us for raising this loan: interest, hedging, and upfront fee. These three are the cost included in this 7 crore 11 lakh. And the detail of this is here. Upfront fee of 1 lakh 20,000 pound, interest payment of 12 lakh 7,000 pound for 3.4 years, hedging cost of 13 lakh 60,000 pound for 3.4 year. All these costs are for 3.4 year. Now what you can do another way, I will tell you. Just 26 lakhs 87,000 is the GBP now for 3.4 year. So divide it by 3.4 year, you will get it for 1 year, and multiply it with 90, you will get exactly 7 crore 11 lakh or 12 lakh something. 2687,000 divided by 3.4 into 90. That's 7 crore 11 lakh 26,000. That's it. Simple. 7 crore 11 lakh 26 471. So this is the proper answer according to me. Okay, sir. Now the last part. Oh, sorry, second last part. That's very easy. They are asking us to calculate what is the cost of hedging in rupee terms. Isn't it easy? The hedging cost is 13 lakh 60,000, sir. When you multiply the 13 lakh 60,000 with 90 rupees of the exchange rate, you will get the hedging cost. And if you have to calculate it on per annum basis, then divide it by 3.4. So 13 lakh 60,000 multiplied by 80. I will show you again. See. 13 lakh 60,000 multiplied by 90. You will get the total 12 lakh 24 crore for all the years. But when you divide it by 3.4, you will get it on per annum basis. Or this is another way. This 10 lakh multiplied by 4% multiplied by 90. Per annum. 4% is per annum, that's why. So in any way you can calculate, the answer will be same. 12.24 crore is for 3.4 years, my friend. Now the third part is interesting. Why did you take the forward contract? I will tell you. Go with the logic of this. See, how much was the 36 million? I think 3 crore 60 lakhs. So hedging cost to you is 3.6 crore, or we can say 36 million if we talk about million. This is the hedging cost, right? Why did you take the hedge? It's very simple, sir. After 5 years, you will be repaying the loan to the bank, and at that time you will buy GBP from current spot market at that time. And what if the rate goes to the spot rate on that date is not in your favor? You will end up paying an extra amount for buying that GBP. And that's why, to avoid the risk of paying extra rupees to buy 10 million GBP in order to make the repayment of principal amount, you took the forward contract. And in the forward contract, you decided that 90 rupees is the cost at which I am going to buy GBP at the end of 5 years. So originally speaking, according to forward contract, you will buy every GBP at 90 rupees, and that will cost you 900 million rupees to repay the loan of 10 million GBP, right? But for that purpose, to fix that 90 rupees per GBP rate, you paid 36 million as the hedging cost. What would have happened if you would have not taken the hedging? Like if you would not have taken forward contract, and if you would have kept your position open for the spot rate of that date, two things would have happened. See, understand. You would have purchased this 10 million at the whatever spot rates are. Let's say, for example, the spot rate goes to 99. From 90, it goes to 99. You will end up paying 990 millions to buy that 10 million GBP. That is almost 90 million extra than the forward contract. If you would have taken forward, you would have only paid 900 million. But since you did not take the forward contract, you did not hedge your risk. Now the rate is 99 rupees per GBP. Every GBP has to be purchased at 99 rupees. So in order to purchase 10 million, you will have to pay 990 millions. And how much extra you are paying? 90 millions. But yeah, there is one benefit. There is a loss of 90 million for sure, because you kept your position unhedged. But there is one benefit. If you keep your position unhedged, you can save up on the hedging cost. Since you have not taken the forward contract, there is no need for hedging cost, 36 million. So ultimate loss to you is 90 million of the loss due to spot rate and less savings in the hedging cost. So ultimate loss will be 54 millions only. But yeah, there are chances that the rate can go down as well to, let's say, for example, 81. If the rate goes to 81 on that date, you will have to pay 810 million 81 multiplied by 10. See, 81 multiplied by 10. 810 million to buy 10 million GBP. So this will be in rupees. And in that case, you will appreciate your decision, because otherwise you would have paid 900 million. And now you are paying 810 only in the spot market. In hedging, you would have paid 900 million. So this is by keeping the position open or unhedged, or by going aggressive, we can say we have a gain of 90 million. Apart from that, since we have not taken the forward contract, we have saved this 36 million as well. So the total profit is 126 million. So this is going to happen if you do not take the forward contract. See, what's the third part? If K Limited wants to pursue an aggressive approach, what do you mean by aggressive approach? That means do not hedge. What would be the net gain or loss for K Limited if INR depreciates or appreciates against GBP by 10%? So, if right now it is 90 rupees per GBP, if it depreciates, it will go to 99. And if it appreciates, it will go to 81. And that's what the rate that I have taken. Question is asking you, in case of non-hedging position or unhedged position, what will be the gain or loss if the rate on that date, 5-year end, is 99 or 81? When you have to buy 10 million GBP to repay to the bank, you will be buying it at 990. See, at any rate, in order to buy 10 million GBP, you will have to pay 810, 900 and 990. So in this case, you are paying 90 million extra. In this case, you are paying 90 million less. So this is a gain. In this case, there will be a gain. In this case, there will be a loss of 90 million. But in both the cases, you will save 36 million of the hedging cost. No need to pay any kind of a hedging cost if you are not hedging. So that's what the question is. Let's have a look. If INR depreciates by 10%, that means from 90 it will go to 99. So out of 900 you will pay 990. So there is a loss of 90 million. Okay. Loss of GBP on 10 million is 90, but you have saved the cost of hedging. So 90 minus 36, the total loss is only 54. But if it appreciates by 10%, so it will go from 90 to 81. You will be paying 810 instead of 900. So there is a profit of 90. So there is a profit of 90 million. Gain on repayment of loan 90 million. Plus you have saved on the cost. This was a loss. This was a loss, this was a gain, and that's why we deducted. This is a gain and this is also a gain, that's why we added. So the net gain is 126 million. That's easy to understand, right? Let's move on to the last question of this chapter. So before starting this question number 18, let's have a look on a new concept, that is geared and ungeared beta. This is related to the beta that you have learned in the portfolio management chapter. First of all, let me introduce or revise the concept of beta. Beta is a measure of systematic risk. It measures the risk of a company as compared to the market, right? And that is what we are going to consider. Have a look. So we are going to discuss about this geared and ungeared beta, and let's have a look on the formula of geared beta. So this beta G means the geared beta. Beta G is the geared beta, which is equal to ungeared beta multiplied by 1 plus debt equity ratio in bracket 1 minus tax. We will derive this formula, don't worry about it. But first let's understand about the concept. Let's say this is a company. This particular thing is a company. Okay. And this company is entirely financed by equity. Only equity. There is no outsiders money included in that equity, in that company. So that company's risk will always be called as the beta of assets, beta of ungeared company, or beta of unlevered company. When you apply that means there is no debt in the company. Similarly, if you take the similar company, exact same company, but the financing in that company, or we have taken loan in that company, That means there is a debt in the company. So if there is a debt in the company along with the equity, that company's risk will be called as beta of equity, beta of geared, or beta levered. Beta geared, beta levered, mostly this. Okay, sir. In that case, this equity beta will be calculated separately. But in that case, the equity beta and the asset beta will be same. But in this case, the asset beta includes equity and debt both. So understand this logic, that in case of ungeared company, that means if there is no debt, the asset beta and the geared equity beta will be same. But in case of a geared company, asset beta will include equity and debt both. So we will have to multiply the beta of equity with the weight of that equity and debt beta with the weight of that debt. Okay, so it will look like this at that time. See, if you want to calculate the beta of the asset beta of a geared company, it will include equity beta into weight of equity, beta debt beta into weight of debt, simply. In this case, there was no need because the equity was the only thing. So equity beta became asset beta. But in this case, we will multiply it. It's as good as taking the weighted average of each beta. Okay, sir, right. Now, couple of things that I want to confirm once before starting the formula. Let's say, for example, this company is going into liquidation. Total equity raised by the company is 5 crore rupees, and this company is now going into liquidation, and only 2 crore rupees is left with the company as a cash. So what will happen? For every share, every 1 rupee of the equity, company will be able to pay only 40 paisa to all the shareholders, because 5 crore is the liability but 2 crore is the only cash left with the company. So this 2 crore will be divided in these 5 crores in the ratio of 0.40:1. So 40 paisa for every 1 rupee will be given to all the shareholders. But what will happen if this 5 crore rupees is structured in this manner? That means 3 crore rupees is of equity and 2 crore rupees is of debt. And now if the company is going into liquidation, and if the company only has 2 crores of the cash left with them, the liquidation procedure says that first you will discharge all the outsiders' money. And in that case, this 2 crore rupees of the cash left with us will be given or paid entirely to the debt holders, and equity holders will get nothing. What does that mean? It means that if you include the debt in the company, if you raise the funds through debt in the company, then your risk becomes higher, or your risk increases. The beta of such a company will be higher than beta of this company. Because in case of liquidation, equity holders will not get the priority. In this case, equity holders are getting at least something. Out of 1 rupee, they are getting 40 paisa. But in this case, in the same situation, equity holders are getting nothing, because the rule says that you will have to first discharge the payment of outsiders. So all the 2 crore rupees will be paid to the debt holders. So when this is a situation, having a debt in the company can be very risky. So one thing is for sure, from this part till the end of the mergers chapter, you need to make sure that the unlevered beta of the company will always be lesser than the levered beta of the same company. So geared beta or levered beta will be higher than the unlevered beta. That is what you need to understand. Okay. Now, geared beta will be higher than the unlevered beta. The risk of the company having debt in capital will be more than the risk of the company having no debt in capital. Okay, now coming over to this part. Understand. We discussed that ungeared beta of the asset and beta of the equity will be same in such company. But in case of geared beta of the asset will be equity and weight of equity, beta of debt and weight of debt. So this will be a weighted average of equity and debt beta. And how to calculate the weight now? Weight is very simple, sir. Take the equity in the numerator and equity plus debt in the denominator along with the tax saving. So there is something in the debt that is beneficial to the company, which is called as tax saving on interest. Okay. In this case, how to calculate the weight of the debt? Take the debt in the numerator and equity plus debt 1 minus tax in the denominator. So it is like if you have 2 crore rupees of the equity and 2 plus 3 crore rupees of the debt. So 2 by 5 will become your total weight of equity. In this case, it will be 3 by 5 will become the total weight of the debt. Okay, got it? So this is how you will calculate the weight. But what happens normally? You can clearly see that in case of a levered company, the risk of equity holders increases, but virtually debt holders had no risk because they knew that in case of liquidation, we will be the first to make the payment. So debt beta virtually is considered as zero. And if we consider the debt beta as zero in this equation, if we assume the debt beta is zero in this equation, this entire part will become zero. And the only equation left will be the asset beta is equal to equity beta into equity divided by E plus D 1 minus tax. Okay, so let's continue with that. Asset beta is equal to equity beta into E divided by E plus D 1 minus tax. Cool. Now what you have to do is transfer this entire equation on the other side, left hand side. So since this is multiplied here, it will come to the denominator of beta of the asset. So it will be like equity beta is equal to asset beta divided by equity plus debt 1 minus tax. Now you can take this as a separate part in this case here as asset beta into 1 divided by equity plus debt into 1 minus tax. When you reverse this equation, this denominator will become the numerator. So equity plus debt into 1 minus tax divided by equity. This is beta of the equity, right? Now, this E is the common for this E and this debt as well. So we have divided it into the both the parts. So when we separate this equation, E will become a part of this E as well and debt E will become a part of the debt as well. So we have divided equally to both. This is happens. Like you can do it like this. I will just show you. Let's say 10 plus 5 divided by 3. 15 divided by 3, the answer should be 5, right? So you can do it 10 by 3 plus 5 by 3 and still the answer will be 5. So you can do it like this. And that's what we have done. We have allotted the equity value to both. So E by E will become 1 now. And this is debt equity 1 minus tax. Now the equation is like this. Beta of the equity is equal to beta of the asset in bracket 1 plus debt equity ratio in bracket 1 minus tax. Now you can clearly understand what this 1 means. It is nothing but E by E. And this is debt by E. E by E, debt by E into 1 minus tax. Now you can write down equity beta as a geared beta also or levered beta also. And the asset beta as ungeared beta or unlevered beta. So this is the formula that you need to understand. It will take a lot of time, like a lot of practice to remember this formula, but it will be used in our calculation. Why we are going to use this formula? I will tell you. We are going to use this formula once to calculate, let's say, asset beta, and then again put that asset beta in the same equation with a different debt equity ratio to calculate the beta of the equity. You will understand it later on. Let's have a look on question number 18 now. This is what the geared and ungeared beta. There is a relation in the geared and ungeared beta. So remember, geared beta is equal to asset beta in bracket 1 plus debt equity ratio into 1 minus tax. So ultimately this is what will be helpful. Now coming over to the question. It's Entertainment Limited, an Indian amusement company, is happy with the success of its water park in India. So this particular company has a water park in India. The company wants to repeat its success in Nepal. Also where it is planning to establish a grand water park with world-class amenities. The company is also encouraged in a marketing research report on which it has just spent 20 lakh rupees. Write down, it is a sunk cost. What does that mean? Because you have already spent 20 lakh rupees on the research, now that 20 lakh rupees is irrelevant for the purpose of decision making. We are not going to change our decision because of this 20 lakh rupees, because you cannot reverse this expense. This has already been done. That's what we call in costing it as a sunk cost. You can type on Google also, and you can ask your seniors as well what is sunk cost in costing. The estimated cost of construction would be Nepali rupee 450 crore. So this is a construction cost. It would be completed in 1 year's time. Half of the construction cost will be paid in the beginning and rest at the end of the year. See. So you will pay 225 here, 225 here as a construction cost. Total 450. Okay. In addition, the working capital requirement would be 65 crores from the year end 1. So 65 crore rupees here. Got it? The after tax realizable value of the fixed assets after 4 years of operation. Operation will start after 1 year, right? Because the entire construction is going to take 1 year. So 4 year will start from this part. 1, 2, 3 and 4. So these are the 4 years of operation. 1, 2, 3 and 4. In total it is 5 years, but operational period is 4 years only. And what the question is saying, after tax net realizable value of the fixed assets after the 4 years of operation is expected to be 250 crores. See, question is clear about the capital gain tax and everything. And that's why they have clearly written this 250 crore is the after tax realizable value. Cool. So once you will dismantle everything after 4 years, you will get 250 crore. Okay. Under the foreign capital encouragement policy of Nepal, company is allowed to claim 20% of the depreciation allowance per year on reducing balance basis subject to a maximum capital of Nepali rupee 200 crore. Even though you have spent 450 crore rupees, but you can only take the depreciation on 200 crore, and that too on a reducing balance method, WDV. So we will have to make an entire table for that. Okay. Now, so 200 into 20% like 40, right? So this is how it will go. 240, then what's left is 160. Then on 160 it's 20%, that's 32. So you can see 40 is also reduced by 20%. And now you can calculate 40 less 20%, 32 less 20%, 25.6 less 20%, 20.48. This is how you can calculate the depreciation fast. Okay, we'll see to that later on. Now, the company can raise the loan for theme park in Nepal at 9%. The water park will have a maximum capacity of 20,000 visitors per day. On an average, it is expected to achieve 70% capacity for its operational 4 years. That means 14,000. 20,000 is the total capacity. Out of that, 70% will be achieved on an average for all the 4 years. The entry ticket is expected to be Nepali rupee 220 per person. In addition to the entry ticket, the company could earn revenue from sale of food and beverages and fancy gift item. So there are 3 sources of revenue. First, the entry ticket of 220. Second, the food and beverages at 150 and 50 rupees per fancy gift items. Okay, sir. Sales margin on food and beverages and fancy gift is 20% and 50%. That means 150 into 20%. That's 30 rupees, and 50 into 50%, that's 25 rupees. So this is the only margin. Let's take the profit directly, right? on fancy gift items and food and beverages. The park would be open for 360 days in a year. Annual staffing cost would be in Nepali rupee 65 crore. See, I think I should write it down. 20,000 is your capacity, out of which 70% will be occupied throughout the year, and 220 is the price. So if we go by this, it was something like 30 lakh 80,000. But let's see what else is there. So 220 is the ticket price, and food and beverages will give us a profit of 30 rupees. Fancy gift items will give us a profit of 25 rupees. Right. So total will be 220 plus 30 plus 25 if there is no inflation included in this. Let's see what happens. Now the annual staffing cost would be 65 crore per annum. The annual insurance cost would be Nepali rupee 5 crore. Okay. Other running and maintenance. Staff cost. There are some costs involved. 65 crore. Insurance cost 5 crore. Running and maintenance will cost 25 crore. In the first year of operation, which is expected to increase by 4 crore every year. Running and maintenance. 25, 29, 33 and 37. The company would apportion existing overhead. Apportionment of overhead is not a cash flow. This is not a cash flow. Not a cash flow. So ignore that 5 crore rupees of the apportionment. Because even if you do not take this project, this cost will have to be incurred and will be debited somewhere else. All costs and receipts, excluding the construction cost, asset realizable value, and other running and maintenance cost mentioned above are at current prices, means 0 point of time. You can say real cash flow. So there are some cost: construction, asset realizable, and other running and maintenance cost. Except for this, everything is at real price, which are expected to increase by 5% every year. And this is where you are going to make a lot of calculation. So what will happen? Everything will include. So they have not excluded the working capital as well. So understand, working capital will also increase by 5%. So 65 plus 5% will become 68.25. That means you will have to add 3.25 lakh rupees in the working capital to make it 68.25. Plus 5%, it will be 71.66. Plus 5%, it will be 75.25. And this is what you can release at the end, 75.25 I think. And 71.66 minus 68.25, that's 3.41. That's 3.58. 59. 75.25 minus 71.66, 3.59. So this is going to be your outflow in working capital every year. $75.25 will be released in the end. See, this is how it is going to be. Every year 5% will be increased. Okay, sir. Apart from that, this will also increase by 5%, this will also increase by 5%, this will also increase by 5%. Ticket, fancy goods item and all this. Means you can directly increase this part, 275 by 5%. Very easy to do that. And what else is given? Acha. Staffing cost of 65 crore will also increase. Insurance cost of 5 crore will also increase by 5%. They are only saying that the running and maintenance cost will not increase by 5%. It is already increasing by 4 crore rupees every year. Okay, sir. The current spot rate is Nepali rupee 1.60 per rupee. So this is indirect quote for us. Tax rate in India is 30% and in Nepal it is 20%. Average market return is 11% and interest rate on treasury bill. See, this is market return. This is treasury risk-free rate. So you got to know that we have to use capital asset pricing model here. And the company's current equity beta is 0.45. This is equity beta. Now understand. This is the company's current beta. The company's funding ratio for the water park would be 55% and 45%. For 55% equity, 45% debt. So the debt equity ratio here will vary. 45 by 55. Debt equity ratio of the water park is 45 by 55. Okay, I will just explain that. Being a tourist place, the amusement industry in Nepal is competitive and very different from its Indian counterpart. See, they are clearly mentioning that the risk from the Indian counterpart, Indian amusement park, will be different for the Nepali amusement park. The company has gathered the relevant information about its nearest competitor in Nepal, competitor's market value. Some competitor in the Nepal we are going to face. Its market value of equity is Nepali rupee 1850 crore and the debt is 510 crore, out of which the equity beta is 1.35. What exactly you have to do? You have to calculate the competitor's debt equity ratio, which is somewhere 510 by 1850. Okay. And this debt equity ratio has to be removed from 1.35 equity beta. Once we remove this debt equity ratio, now we can apply we will convert this equity beta to asset beta. And then that asset beta will be used with this debt equity ratio of our amusement park to get back to equity beta. I will just explain that. State whether its Entertainment Limited should undertake the water project in Nepal or not. I will explain you step by step. See, in order to discount the cash flows, first you will have to use the capital asset pricing model. And the capital asset pricing model says that risk-free rate of interest into beta of equity, market rate minus risk-free rate, right? So we have been given with the market rate of 11% and the risk-free rate of 8%. So risk-free rate 8%, market 11 minus 8. The only thing that is not given in the question is the beta of equity. Now you might say that the beta of equity of 1.35 to given, sir. Right. Can we use that? No, we cannot use that. So can we use this equity beta of 0.45? We cannot use that as well. I will tell you. There are three entities in the question. First one is the Indian company. Okay. Second one is the Nepal subsidiary, we can say, or Nepal project of Indian company. And the third one is the Nepal's competitor. Okay. Indian company has a debt equity ratio, equity beta of 0.45. Nepal competitors has a beta of equity of 1.35. Now please understand, we need to find out the NPV of this project, right? Nepal project. And accordingly, we need the equity beta for the Nepal project. We cannot use this beta because it is clearly mentioned in the question that Indian counterpart or the Indian amusement park is very different from the Nepali project. That means the risk of both will be different and beta itself represents risk. So beta will also be different. That's why we cannot use this. Again, Nepal's competitor is will match. Nepal's competitor will match almost with the Nepali project that we are going to implement. But we cannot use this 1.35 because the debt equity ratio of competitor is different than our debt equity ratio. Our debt equity ratio will be 45-55 and his debt equity ratio is something different. So what exactly we have to do? It's very simple, sir. You take the equity beta of the competitor, remove its own debt equity ratio out of the equity beta and convert that to asset beta. Means a company which only has equity, and this asset beta can be applied to our project. So we will add our debt equity ratio 45 by 55 to again calculate the equity beta. This is 510 by 1850. So what are we doing in this case? Understand. We are removing the debt equity or the risk of this ratio from this beta of the competitor. Now we will have this beta which can be applied to any of the company, because this is all equity financed in Nepal itself. Both the companies will be equity financed, both the companies will be in Nepal. So we can apply this to our project. But our project is also does also include debt. So we will have to add the debt equity ratio of this. So basically we are removing the risk of this debt equity ratio and adding the risk of this debt equity ratio, and then this equity beta can be used in the capital asset pricing model. You got that? So let's start with the concept. So equity beta is equal to asset beta in bracket 1 plus debt equity ratio 1 minus tax. You start putting the values in here. Have a look. See, you took 1 point. Yeah, they have used a different formula. It should be equal here. See, I will do it my way. The normal formula used. This is the equity beta of the competitor. We want to calculate asset beta 1 plus debt equity ratio. It's 510 by 1850. What is the tax rate? Tax rate is 20%. So we can simply take 1 minus 0.20, which will be 80%. So 510 divided by 1850 into 80% plus 1. So that's 1.35 is equal to asset beta into 1.2205. So the asset beta will be 1.1061. So we have now converted the debt beta into asset beta. So practically we have removed the risk of debt. We have removed the risk of debt from the equity beta, and that's why you can clearly see the beta has reduced, because the risk has reduced. You have removed the debt from the company virtually, and if you remove the debt from the company, it will become 1.1061. Now again, equity beta is equal to asset beta in bracket 1 plus debt equity ratio 1 minus tax. That means we are going to add 1.1061 our debt equity ratio 45 by 55 1 minus 0.20. So our equity beta comes to 1.83. So if we add our debt equity ratio, it comes to 1.83. So equity beta converted to asset beta, again converted to equity beta. This is the process of removing someone else's debt equity risk, adding our debt equity risk. See, 1.83. Do you agree with this? 1.83. Now you can use this equity beta in the capital asset pricing model. So if you put it in the capital asset pricing model, you will get the cost of equity as 13.49. Now the discounting rate will not be just the cost of equity, because we have debt also in the company. WACC will be calculated, weighted average cost of capital, which is nothing but cost of equity into weight of equity plus cost of debt 1 minus tax into weight of debt. Isn't it? Do you think it is right? Yes, sir, it is right. It's clearly mentioned in the question that our capital includes equity and debt both. So what exactly we have to use for the discounting rate? Cost of capital. This is the weight. This is the weight. You use the cost of equity, cost of debt, and then do the total. This will be your discounting rate, 10.66, I think. So 10.66 will become your discounting rate. and the present value factor at that rate is being calculated in the second working. Okay. Now your true calculations will start. I think from this point onwards, there is no need for me to interfere in the answers. Now it's very easy. The only part or the only point of taking this question is explaining this geared and ungeared relation. In order to calculate a discount rate, see, I will just show you the linking. In order to calculate a discount rate, WACC, you needed four things: cost of equity, weight of equity, plus cost of debt 1 minus tax because of tax saving into weight of debt. We had this, this and this, but we didn't have cost of equity. So for that purpose, we used capital asset pricing model, risk-free rate plus beta of equity into market rate minus risk-free rate. We had this, this and this, but we didn't have beta of equity. So first we took the competitor's beta, converted that to asset beta, converted back to equity beta, and then it was used in the CAPM. So this is the procedure. Ultimately we wanted this. Got it? This is how we have gone. Now considering the cash flows. So this is the depreciation calculation. You can see 40 less 20% less 20% and less 20%. If you directly want to calculate the depreciation in case of WDV method, 20% is the written down value. So once you calculate 40, you can reduce 20% every year from that to arrive at the depreciation. So 40 less 20% less 20% less 20%. So these are the four depreciation for 4 years, and still the WDV is 81.92. Please remember that. Calculation of the present cash flows. See, there are three types of cash flows that you need to understand. Revenue. I'm just all the cash flows are at current prices. That means 0 point of time. And you understand one thing, all the operations are starting from the end of, where is that? From the end of year 2. Can you imagine? All the cash flows are here, and the cash flows or like revenue, cost, everything, operations are starting from the end of year 2. That means you will have to add 2 years 5% increment. Question clearly says that it will increase by 5% every year, for the first year as well, for the second year as well. So you can have a clear idea from here. It was 225 plus 5% plus 5%. What was that? 225 or what? Let me just confirm. 200 na. Entry ticket was 220. Sorry. So entry ticket was 220. So you have to calculate it like this: 220 at 0th time into 1.05 into 1.05, and then you will reach at the second year end 2 times. Again, for this 30 was the profit from sale of food and beverages. You can calculate it like this: 150 into 20%, which was 30, into 1.05 into 1.05. 50 was the sale of fancy gift items and 50% was the margin. So 25 into 1.05 into 1.05, and you will keep on increasing 1.05 every year for the rest of the 4 years. Then this is the revenue per visitor, and this is the total of 3 items: ticket price, food and beverages, and fancy gift. Okay, so this is the total revenue in terms of crores when multiplied with the annual visitors. How do you calculate the annual visitors? Daily visitors is 14,000, sir. So 14,000 into 360 times 360 days, this market will be open, this amusement park will be open. So total visitors in the entire year is 50,40,000, and from everyone we are collecting 303.19 rupees. So this is per person. When multiplied with the total number, we will get the values in crores, Nepali rupee. This is in crores. Now let's deduct the costing. Annual staff cost. It was 65 crore into 1.05 into 1.05. Am I right? right, and it will keep on increasing. Insurance cost, question clearly says that insurance is also included in this. 5.1.5 into 1.05 into 1.05. It will keep on increasing for the rest of the 4 years. Good, sir. Then other running and maintenance cost, it was though excluded from that 5% increment, and question clearly said that for the first year it will be 25 and then it will keep on increasing by 4 crore every year. Cool. Next thing is the depreciation that we have calculated at written down value method. This will be total expenses, profit, net profit, tax on the profit. Then this is the net profit. Please understand, this is just a profit. This is not a cash flow. We will have to add back the depreciation in that if we want to calculate. Okay, so this is the park's construction cost, 225 in the 0 and the first year, and then after tax realizable value 250 at the end of the year when we will sell this project. This is the working capital every year required. I told you it will be 65 in the beginning, but because 5% is increasing every year, 5% is increasing every year, we will have to make a cash outflow of the balance amount. So let me write down the final values. It will be 68.25. So 68.25 minus 65 is the extra additional working capital required. 71.66 and 75.24. 254, whatever you want to take. And at the end, everything will be recovered. So how do you calculate the net cash flows? It's very simple, sir. Net profit less this plus this less this and add depreciation back. Depreciation has to be added, right? So you will reach at this net cash flow of Nepali rupee. Take the discounting rate of 10.66% that we calculated in the beginning, and then the present value. It is coming to negative. You will reject the project. Simply. Make sure that you are adding the depreciation. I will just write down how did we calculate this. I will have to keep the marking from the beginning. So let's start. A, B, C, D, E, F, G, H. I, J, K, L, M, N, O, P, Q. So, what is the total of R? Let me just do the working here. So, we took net profit N plus depreciation J minus construction cost O plus realization value P and less working capital. Less, basically speaking, we can add all of them because minus sign has already been given here. So we can add everything. Let's add Q. So the total of all this will be R, that is the net cash flow. Got it? I think this part is a little easy, not that difficult to understand. The only difficult part was the calculation of discounting rate, 10.66%. Rest of the parts, in this part, the only difficult one was to understand the growth of 1.05%, like 5%. Multiplying 1.05 two times. That was the trick in this part. And to remember that which particular cost or transaction is excluded from that 5%. Just like other running and maintenance costs, it was not included. Depreciation will also not get affected by it. So these two are calculated differently. So this is how you have to go with the questions of international financial management. I hope you have liked it. But I will tell you, like solving the questions will be a time-taking process for this chapter. So in exam, if the question comes like this much of the answers is there, please keep it for the end of the paper, because there are mostly chances that you will make some mistake and end up wasting your time. So do not pick such type of questions which are very big in answers in the middle of the paper. Keep it for the end. So now we are just going to end this chapter, International Financial Management. In the next lecture, we are going to start with the corporate valuation. We have 44 questions in that, and we are going to do it. We are going to enjoy corporate valuation, mergers and acquisition. See you, sir.